And that was the first time I saw a crack in the system, and I realized if you give someone else the power to feed you, you're also giving them the power to starve you. And that's when I really understood, okay, I need to learn about money.
The most dangerous lie in personal finance is that your job equals security. In this conversation with Nischa Shah, we're tearing that idea apart and replacing it with the hard-won principles of true financial sovereignty. We're going to start with the single most profound and counterintuitive lesson in investing, which explains why most people who are actively trying to build wealth are actually sabotaging themselves.
Fidelity looked into the groups of people that had invested in their funds to see which group performed the best. And when they looked into it, they found one group significantly outperformed all other groups when it came to investment returns. And that was dead people. Dead people outperformed the living when it came to investment returns because they didn't touch their investment account. They just set it, forget it. They didn't chase the next company stock. They didn't go after the thing that's going to go up really quickly and down really quickly. And that all ties into the behavior. You're not letting your emotions drive the investments. And by the way, they found that the second best performing group were the people who forgot that they had a fund in the first place.
This isn't just a funny anecdote. It's the core strategic principle of long-term wealth creation. The single biggest threat to your portfolio isn't a market crash, it's you. It's your fear, your greed, and your impulse to do something when the market gets volatile. The financial system is designed to trigger these emotions and get you to transact, to buy high and sell low. I think the deepest insight here is that significant wealth isn't built by making a series of brilliant moves. It's built by consistently avoiding stupid ones. The winning strategy is to build a sound, diversified portfolio of assets like index funds and then remove your own emotions from the equation entirely. Automate your contributions and then act like you're dead. Let the system of compounding do its work without your interference. This idea of questioning a default strategy applies directly to what is for most people the single biggest financial decision of their lives, buying a house.
Actually, I went onto the property ladder, and the money that I put in towards that flat hasn't grown as near as much as the money that I made through the stock market.
By investing in the S&P 500?
Yeah.
So tell me about that. So you bought a property in London or somewhere in the world?
In North London.
Okay.
To live in.
Okay.
And I bought it in 2017.
Okay.
Yeah. And it's gone up in value, I'd say about 10%.
Okay.
I've had it for 8 years. Then you compare that to the stock market. So sure, there's a number side of it where people think, okay, I need to buy a house to build wealth. But that's what I'm trying to explain, that actually, if you save that money and you invested it, you might be better off financially.
This is a perfect real-world example of opportunity cost. The conventional script tells us that getting on the property ladder is the cornerstone of wealth. But we have to be absolutely ruthless about looking at the numbers, not the narrative. Her property went up 10% in 8 years. In that same time frame, the S&P 500 more than doubled. That is a staggering difference in outcomes. The core principle is that you must evaluate every major capital decision not just on its own merits, but against your next best alternative. While a mortgage provides a forced savings mechanism, which is good for discipline, it also locks up a huge amount of capital in a single, illiquid asset class. For the disciplined wealth builder, that same capital, deployed into the broad market, could generate vastly superior returns. The lesson is clear. Run the numbers for yourself. Don't just follow the script. Of course, to run the numbers, you need a system. There's a simple, powerful framework for allocating every dollar you earn.
So I would actually say this is really important for anyone to know, and it's the 3 numbers. It's called the 65-20-15, and it's 3 numbers that anyone should know when it comes to money and their own personal finance.
Okay, 65-20-15, okay.
And the way it works is the idea of it is to take your net income. This is your take-home pay after you pay taxes, not the number on your job description. The number after you pay state contribution, all other taxes. And you want to split that into 3 buckets. the fundamental, which is your core living expenses, everything that is essential to your living costs, mortgage and rent, utilities, groceries, minimum debt payments, car payments, all of that should make up approximately 65% of your net income.
Okay.
The 20%, that's for your fun spending. These are for the pottery painting that you booked last minute, the Glastonbury tickets, the Pilates class. That should make up about 20% of your take-home pay. And the remaining 15%, that's for your future you. That's today's you, planting seeds for tomorrow's you. And that should go to savings, investments, and extra debt payments.
The principle here is intentional allocation. This isn't a restrictive budget. It's an offensive plan for your money. You give every dollar a job before you even have a chance to spend it impulsively. This is how you automate the process of building wealth. From my perspective, that 15% for future you is the only number that truly matters in the long run. That is your freedom fund. The entire game is about protecting and relentlessly growing that percentage over time. The 65% for essentials is where the battle against lifestyle inflation is won or lost. As your income grows, if you can hold that 65% steady or even shrink it, you create a wider and wider gap to pour into your investments. That is the accelerator for financial independence. Implementing a system like this is non-negotiable. Because as we're about to hear, the traditional system of security is a complete illusion.
And I remember thinking at the time that this person believed in financial security. This person believed in the blueprint, and it was taken from her. And now I'm in her shoes. What's to say that the same won't happen to me? And that was the first time I saw a crack in the system, and I realized if you give someone else the power to feed you, you're also giving them the power to starve you. And that's when I really understood, okay, I need to learn about money. I need to stop spending it in the way that I'm spending it. I need to stop having this mindset around money, because what it's done right now is it's kind of trapped me. So what I did is took the power back in my own hands, did everything I needed to learn how to save, spend, invest, budget.
This is the crucial mindset shift that every aspiring wealth builder must make. The core principle is this: a job is not security. True security comes from owning and controlling income-producing assets. A high salary might feel safe, but it can disappear overnight. It's fragile because you don't own the system that produces it. This is the psychological leap from an employee mindset to an owner's mindset. You have to stop seeing your job as your security blanket and start seeing it as your primary tool for acquiring assets. Your salary is the seed capital you use to build your own financial fortress, a fortress that can feed you long after the job is gone. Until you internalize that, you will always be strategically vulnerable. This brings us to the first and most important asset you need to build: your own income.
If you have a lump sum amount that you're like, okay, you know what, I have 2,000 that I want to invest, what should I do with it? It's taking me 5 years to invest this. I would say 1,900 of that, don't invest it. 100 of it, invest. I'll say why I'm saying this. 100, I want you to invest it. For anyone listening, I want you to listen. I want you to invest that because I want you to see and feel the emotions when you see your money go up over time. Sure, it's going to be small. It's not going to make you rich investing that, but you're going to instill that good habit early on, and you're going to remember that. Because the remaining amount, you're going to put that towards increasing your income. That's the first thing you're going to do.
The strategic principle here is leverage. In the early stages of your journey, your single highest point of leverage is not your investment portfolio, it's your ability to earn. A 10% market return on a small sum of money is insignificant compared to the return from acquiring a new skill that gets you a $10,000 raise. Too many people get fixated on finding the perfect investment when they really have an income problem. Your income is the engine of your wealth-building machine. The first order of business is to build the biggest, most powerful engine you possibly can. Focus on your skills, your value in the marketplace, and your career trajectory. Once that engine is roaring, you'll have serious fuel to compound through investing. It's all about sequencing your actions for maximum impact. And once that income engine is running strong, there is a clear, sequential playbook for putting that capital to work.
The very first thing, number one, that I would say to do is build a peace of mind fund.
A peace of mind fund.
This is not about maths. It's not the mathematically optimal thing to do, but it is the psychological. Because as we've discussed, money is as much about emotions as it is about numbers. So what I'll say is go through the last 30 days of your bank statements and calculate exactly how much it costs for 1 month of your living. So mortgage, rent, utilities, bills, minimum debt payments, car payments, and whatever that total is, that's the amount that you want to save up for your peace of mind fund.
This entire sequence, the peace of mind fund, paying off high-interest debt, and building a full 3 to 6 month emergency buffer is about one thing: building a stable financial foundation. The principle is that you cannot build a skyscraper on quicksand. High-interest debt is financial quicksand. A lack of emergency savings is a crack in your foundation that guarantees that any small life event becomes a major financial crisis. You handle these things first so that you can finally invest from a position of strength and logic, not fear and desperation. This foundation is what allows you to ride out market volatility and avoid being a forced seller at the worst possible time, which, as we saw at the start, is the #1 mistake investors make. Ultimately, building real wealth isn't about a secret stock tip or a lucky break. It's about systematically rejecting flawed societal scripts and building your own robust systems for your money, your career, and your behavior. What's the one system you're going to implement this week to take control? Let me know in the comments, and don't forget to like and subscribe for more strategies to build real freedom.